और चौथे के time
Hello everyone, and welcome to this webinar on budget 2016-17 by Angel Broking. So the FM really, delivered a pretty predictable budget yesterday, and he more or less delivered on everything that was expected from him. The main focus this time around for this government was to really rein in the fiscal deficit and keep it at that 3.5% mark. So that would instill confidence in foreign investors, who are watching very closely, these kind of macro parameters, especially considering that the global environment right now is quite volatile. So any country which sort of stands out with very strong economic fundamentals, low current account deficit, low fiscal deficit, and even without having a fiscal deficit, being on a high growth path, I think that really speaks a lot about India. And by sort of being very disciplined, the FM has really, in our view, managed to increase confidence in India's fundamentals, and which should really enthuse foreign investors as well as domestic investors alike. The most important part, in fact, about this 3.5% fiscal deficit is that he has achieved this, in our view, with very sort of reliable and credible accounting. We've seen in some of the past years that the numbers in the budget were achieved through some kind of little bit of accounting gimmicks or jugglery. This time around, what we have seen, in fact, what was achieved in the FY16 budget in terms of actual execution and what has been projected for FY17 by the finance minister is quite realistic, which gives further confidence about this 3.5% deficit. I think that sets the ground for the RBI to cut interest rates. It creates a downward bias for interest rates in the economy. In our view, the government was able to achieve this to a large extent because of the huge windfall gains due to the fall in crude prices, which the government has retained in the form of higher duties on petroleum products. This has really improved the fundamentals of the government's fiscal maths, and has given them a lot of money to improve the finances, to bring down the deficit, and at the same time, actually focus on their key sort of development agenda as well. I think, as expected in this budget, being sort of in the middle of their 5-year term, the focus is now slowly coming onto rural India as well. Rural India was suffering from 2 consecutive bad monsoons as well, and was really needed the attention of the government. And so, as expected, this time the FM has increased the spending in rural India by 32%, but he has not compromised on the development agenda by also increasing the road budget by a good amount, by 23% as well. So the way we see it is, there would be clever spending on infrastructure, on urban infrastructure, on roads and highways, that would continue. We have seen that in FY16 as well. That will continue in FY17. At the same time, rural India also will see good amount of money coming into their hands, and that should revive rural growth and create consumption demand in the economy. The other good thing about the way he has done this rural spending, unlike in the previous governments, who resorted to populism in the form of debt waivers or sort of handouts, instead of that, FM has really increased the allocation to rural spending on very efficient and sort of logical programs such as irrigation, crop insurance, LPG gas. Many of these things coming together to improve the standard of living, the capacity in rural India, and none of this is likely to stoke inflation. Food inflation was a big problem in the last in the previous government, because they were just handouts and no real increase in production or in capacity. By focusing on capacity, I think this government will create a better situation in rural India without creating inflation. I think if you combine all these things, it does look like a pretty decent budget. It would have been too much to expect some sort of a overly imaginative or out there kind of budget. I think prudence, discipline, these are the core fundamentals and principles to which the FM has stuck. I think overall that's why this budget has been cheered by the markets. There are winners and losers in terms of sectors and stocks, which we will discuss during the course of the webinar. I think broadly, I would conclude by saying that it's a pretty reasonable budget which delivers on what was expected. With this, I'll hand over to Mayuresh, who will also talk about more about the budget.
Good afternoon, everyone. Thanks, Vaibhav. So as Vaibhav pointed out, the budget seems to be very balanced in its approach towards rural spending. And what everyone expected, more or less, in terms of infrastructure spending to come through, the Exchequer probably has delivered on those fronts. As Vaibhav pointed out, I think it was a little bit too much to expect too many things to come from the budget. And what he's tried to do pragmatically is to include a lot of all these goodies specifically for the rural and irrigation kind of schemes and areas. And the allocation of 1,37,600 odd crores is a positive step in this direction. The increased allocation to roads and highways, close to that 57,600 odd crore mark, is also going to boost the infrastructure activities going forward. And the government is doing all efforts in terms of speeding up block projects which are stuck up. And if there is some incremental addition happening on that count, clearly I think you'll expect some positive moves happening on that count as well. The capex expenditure, more or less in line with what the government had envisaged, lower than what we had estimated. Revenue expenditure more or less in line. The net tax receipts probably a little bit lower than what we had estimated. But again, I think in terms of the nominal GDP growth, which the government is assuming close to 11%, one can really expect that the tax expectations that the Exchequer has put forth should be largely met in FY17. Now the whole action probably shifts to what Raghuram Rajan will initiate in his policy action, because the government has embarked on its path of fiscal consolidation. He has stuck to his targets of 3.5%, and that clearly augurs well in terms of how the economists and the rating agencies will view India. It also gives a clear-cut signal and a headroom for RBI to cut rates, and if that happens in the policy expected in April, probably as expected to see more consumption demand come through as transmissions start happening. And again, I think if the monsoons are better than what anyone expects, that demand should also get a fill. So clearly, I think rural spending, rural infrastructure spending, if you talk about how he's allocated 19,000 odd crores for the Grameen Sadak Yojana, the irrigation schemes, the crop insurance that Vaibhav was mentioning, we are steps in the right direction, in my opinion, and they should have a huge amount of impact as far as rural discretionary spending is concerned. And if that starts coming through, those patterns will be very, very evident on a lot of cash flows of discretionary companies on the consumer side. Corporate earnings obviously will take another quarter at least to show significant signs of improvement, and the capex cycle will also take that amount of time. So with this, I think a balanced approach is what the FM has embarked upon. The markets are reacting probably to what the FM has delivered, and again to global cues. What happens globally, I think, is an unknown at this point of time, and we probably might be hostage to volatile movements world over. But generally, I think the world is probably more focused at this point with liquidity issues. And domestically, at least, I think it's more of a contagion if we get about this. So with this, I think I hand over the mic to Siddharth for his technical and derivative synopsis of the market.
Hello, friends. I've never seen in last 10-12 years, I don't know about 2008, but in last 10-12 years, I've not seen people going so negative in budget, where people didn't have any positive expectations, and people had negative expectations like long-term capital gain tax and other things. So this clearly suggested that we are going very, very light in terms of long positions in market. We had seen more of short positions. If you just recall the day of budget and how market moved, there were 3 points to which market reacted negatively. First being, when the recapitalization figure for PSU banks was just 25,000 crores, and expectation was anything above 35,000 crores. Uh, Second, when there was this corporate tax announcement of 29% for companies having 5 crore or less turnover, and most of the people were expecting that this would be done for each and every company irrespective of turnover. That didn't happen. Then market corrected, and the last and final time market corrected when FM spoke about STT, and more or less in the same breath he spoke about 10 to 15% taxes on tobacco companies, and we all know that how much weightage ITC carry in this market. To all these three reactions, I think it was overreaction from market. All these three news points, it was overreaction from market, and we have seen how within intraday market bounced back significantly. And today also we are seeing a sharp rally in market, which clearly suggests that we have been going in this budget quite negative for no rhyme or reason, irrespective of what is global scenario. And this bounce back was pretty much anticipated, and this bounce back may continue to 7250 odd levels, or probably more. Just to give some clarification on the STT front. Uh, yeah, STT for options have been increased from 0.017% to 0.05, which is like people are talking about three times. So it sounds like it is three times. It is not as severe or aggressive as people are making out it to be. First thing, STT on option is only on the sell side. You don't pay STT when you're buying an option. Secondly, that this STT is on the premium value of option and not the contract value. So suppose, just a case in point, if you say sell some nifty option for say 100 rupees, the premium value of that option would be like 75, the lot size multiplied by 100, 7,500. So previously on 0.017% per se, you are paying around 1 rupees 30 paisa as STT, actual 1 rupee 30 paisa. And now you'll be paying 3 rupees 75 paisa. So it's no big deal. And I really fail to understand why this was not just part of annexure, and why FM had to mention this in his speech, which gave some negative understanding to market, and market corrected. What I feel from the data point of view, a lot of people are making fuss and fuss about how FIs are selling in cash market segment. Even on budget day, they sold 2,000 crores. Yesterday, they sold somewhere around 600, 700 crores in cash market. But we are comfortably ignoring what they are doing in FNO market. In index futures, they are buyers to the tune of around 1,200, 1,300 crores in last two trading sessions. In stock futures, they are again buyers of 1,200, 1,300 crores in last two trading sessions. So whatever quantity they have sold in cash market, they have been buying in FNO market. I am not saying it's an arbitrage. What I'm trying to say is they are not wholeheartedly selling. We have seen in past that when these guys come to sell our market, they sell in cash market, they sell in FNO, they go short in index. That kind of selling is not visible. So according to me, we are not going to see a significant crash from current levels. I am not saying that bottom has been made. Maybe from short-term perspective, if we move above 7,200 on closing basis, then from short-term perspective, say probably for this series, we might have made the bottom. But there's no need to panic in this market, and option traders won't be affected by what has happened in budget. If I add something about rollovers also, Bank Nifty has seen huge amount of short positions getting rolled over, and now when as Vaibhav mentioned about fiscal deficit maintained at 3.5%, and FM showing fiscal prudence, there is a huge scope of now interest rate reduction happening probably in next meet or probably before, and which is leading to short covering rally in Bank Nifty, which you are witnessing right now. And this rally may continue for some more time, be it PSU or private sector, because there are a lot of short positions which are standing. So I would suggest, at least for this series, one should move away from the strategy of sell on rise market, because this market may have some more headroom from current levels for March series. With this, I think we can have now forum open for question and answers.
So the first question that we have is, which are the sectors that will benefit the most from the budget? I think in terms of clear winners, we have the infrastructure sector, road players like Sadbhav Engineering, PNC Infratech. These kind of companies will certainly benefit. We will also see benefit from companies which are dependent on rural consumption. So FMCG companies will benefit, two-wheeler companies like Hero, TVS Motor, they would benefit, even tractor companies like Escorts would benefit to an extent. Irrigation companies such as Jain Irrigation, some of these infra companies which are into irrigation will benefit. Even so we have some of these smaller sectors as well, where we have sort of, hits and misses within the sector. The banking sector, we had a bit of a neutral budget. The clear positive is that government borrowing will be less because they've not overspent, and so interest rates should come down. While at the same time, they could not give enough capital to PSU banks, which are reeling under stress of NPAs. So the amount of capital made available to PSUs, that is a bit of a negative. But I think broadly, the fiscal positive, and the interest rates coming down, I think broadly that becomes a positive for the banking sector. Of course, within the banking sector, we would prefer the private sector banks itself. Housing was another sector which is a clear winner. Housing for All is a major program for the government, and they give a lot of incentives for that. For builders who make low-cost housing, their profits will be exempt. The income tax deduction towards housing home loan interest was increased, for smaller home loans. So companies which are into that, so housing finance companies like Divan Housing, LIC Housing, Repco, these kind of stocks will benefit. We would also see benefit for housing construction companies into low-cost housing like Ashiana Housing. And I think broadly these are some of the winners from this budget. Mayuresh, would you like to add anything?
I think there were a couple of questions specifically in terms of what impact the RBI policy will have with FL embarking on this. As I mentioned earlier, with the finance minister sticking to his fiscal consolidation path, one of the key parameters that the government had put forth was sticking to fiscal consolidation. He's rightfully done that. So clearly, I think one really expects a rate cut to come through. In what quantum? I think one really expects anywhere between 25 to 50 odd bits to come through. And that should provide a fillip in terms of the transmission going through by the respective banks. There were a few questions related to Vaibhav was mentioning on sectors. So broadly, I think he stressed upon sectors which will get positively impacted. Housing finance companies has a huge plus. As I mentioned earlier, I think discretionary as a theme, specifically on the consumer part, is going to get benefited in a significant manner, in my opinion. With the kind of spending that one really expects, both in terms of what the Exchequer has done in terms of allocation towards rural India, as well as the commissioning of the 7th-day commission recommendations, as well as all of, we're probably expected to see some boost happening across a variety of stocks. So whether that be white good appliance companies, whether they be companies which offer a wide range of services, branded products, something which Dabur offers, two-wheelers, clearly again will have some amount of a positive impact. So I think these sectors will get impacted positively. So I think the only hope now is how the rains and the monsoons pan out. If they are for the better this time round, it is definitely going to provide a fillip, both in terms of consumer discretionary stock as well as the white good appliances.
So there is a question on that what would be the impact of this new tax of 10% on dividend if it is above 10 lakhs. So just imagine that you are getting a 10 lakh rupees dividend per annum. If you take, approximate yield for index, dividend yield, that would be somewhere around 2% at these lower levels. So according to 2% dividend yield, if it is 10 lakh rupees of dividend which I'm getting, you need to have a portfolio worth 5 crore rupees or more. So not many retail HNIs have that kind of portfolio. So it's mainly rich who are having that kind of portfolio. They were just paying dividend distribution tax, which FM felt that is unfair and should be taxed more. So it is not for retail HNIs, it is for ultra HNIs and companies, and especially this rule is made to target those promoters who are paying hefty dividends to themselves and hence avoiding higher taxation to their incomes. So they are the main targets and not the general participants of market. So I don't see any negative impact of this on any stock as such. In fact, this will only discourage management to give dividend to themselves and put that extra money back into company to generate more ROE. So it won't have any negative impact. There's one more question which says that why, despite 10 to 15% rise in excise duty in cigarettes, stock like ITC and others went up today. That is post budget. So reason being, it's now a very dumb understanding that budget is there and there will be an hike in excise duty to cigarette companies and everything goes down. So if you recall, ITC is correcting from 320, 330 odd levels because of this expectation. And fine print suggests that the excise duty hike is not as high as what market was anticipating, and hence from 275, 280 odd levels, you have seen a good bounce back. Stock had good support around 285. It's in a strong up move right now, but I feel the up move would again get restricted to 340, 350 odd levels to ITC. I won't suggest you do fresh buying in ITC, but those who are traders can definitely sell some of the put options in ITC because IVs are still high and those IVs will come down.
So on ITC, from a fundamental perspective, I'd like to add that I think clearly in the last two budgets we've seen huge increase in taxes on cigarettes. And because of that, volumes had actually started getting impacted for ITC. The thing you need to understand about ITC cigarette business, like any other cigarette business, the demand is very inelastic, and ITC has been able to pass on the increase in taxes year after year, for more than 10, 15 years, and still have managed to increase their profitability. I think in the last 2 years, the tax increases were so much that there was some impact on their volumes. So this time around, there were some expectations before the budget that the increase would be less than, it would be close to 5-10% or even less. When the budget was announced, the FM said 10 to 15% would be the hike, and initially the stock again took a hit, remembering the impact of last couple of years. But detailed analysis indicated that the impact on ITC, would be up to 10% hike in duties. Which in our view they should be able to absorb and pass on to their customers. And the fact remains, ITC stock has underperformed a lot and is trading at pretty attractive valuations for this kind of a business. So yeah, from a fundamental perspective, I think for a long-term investor, ITC at these valuations is a decent stock to look at.
There's a particular question related to why the Exchequer did not reduce the corporate tax and what kind of an impact it will have. Now, if you look at the budget proposals in FY16 that the Exchequer had given out, it had given a roadmap, and that roadmap clearly defined that he will phase it out over the next few years. And with that process, I think he's also going to phase out the exemptions that the companies probably enjoy. Now, when I was hearing the Revenue Secretary late in the evening yesterday, his argument and his thesis was that if exemptions are not phased out properly, and if a 1% cut in taxes is adhered to, you're probably looking at a revenue loss of close to 40 to 50,000 odd crores. And what you probably get from exemptions, if they are phased out simultaneously at this point of time, is close to around 3,000 odd crores. So again, there's going to be a bridge of around 12,000 crores, which the government does not have resources at this point of time to mobilize that figure. So clearly, I think it's going to happen over a period of time. And again, I think one really needs to understand that it cannot be applicable as a generic thing for all companies. So I think certain companies enjoy different taxes, so you need to also have categorization on that front. So I don't perceive this to be negative for corporate India per se. I think the roadmap is defined. Now, how he does that over the next few quarters or in the next budget is something to be seen. But clearly, I think exemptions need to be phased out carefully. And then I think those 1% cuts that one really expects to come through in the next few years can happen. But clearly, I think it's going to be industry-wise, and it cannot be generically said for all corporates and market capitalization of all companies spread across, whether in the listed or the unlisted. Okay, so we've got one more question related to the oil and gas sector. Now, the disappointment here was more or less to do with whatever cess was being levied at 4,500 rupees. Clearly, I think with ad valorem coming through, there were expectations of how do you price the Brent, how do you price the duties, and how do you price the cess there. Now at $30, the arguments that ONGC and the other management specifically on the upstream are that if it's $30 at this point of time, and if you probably assume the rate to remain similar over the next year or so, whatever they were paying earlier as a fixed cess, with the ad valorem, the cess actually gets down over a period of time. But again, I think this is much lesser than what the markets are probably expecting or were anticipating. And secondly, I think the movement of crude is largely unknown at this point of time. So there is a huge spurt happening with the assumption that it moves above 30 and the average stays above 35. You're probably going to take a hit in terms of what savings you are probably anticipating at the beginning of the year. So this is the reason probably I think the markets are a little bit shaky, specifically on upstream companies. Downstream, I think the story is probably very well known at this point of time, with crude prices staying benign and low. The under recoveries, the working capital constraints have come down significantly. With cash flows improving, a lot of companies have actually reduced their debt. And again, I think they're pursuing capex in the right direction. And if that probably happens, the throughput remains the same for a lot of companies on the refining part. What happens on the diesel marketing margins? And slowly and steadily, I think that spread is improving in terms of margins going up. But that will again take time. And again, I think the capex, as they embark upon, and the throughput that they probably come through, I think is going to be a huge factor. So I think upstream companies are probably getting impacted because of this cess overhang that they've got. Downstream companies largely are factoring in a lot of positives that you're probably seeing from.
All right, so we got a question on whether to expect a rate cut from the RBI. I think the very clear and definitive answer for this is that yes, the RBI is expected to cut rates by at least 25 basis points within the next week or so. In the previous policy, the governor, RBI governor, had sort of mentioned that his next rate cut would be contingent on the budget being very sensible and sticking to the fiscal targets. And the FMS delivered bang on as far as the fiscal targets are concerned. And if you look at the other factors such as the overall inflation rate in the economy, the fact that commodity prices are still coming down, and the need for lower interest rates in India to revive growth further, and there is no question that there is a downward bias to interest rates, and the governor should also now oblige with a 25 basis points rate cut at least, and that should be positive for rate-sensitive sectors like banks, real estate, etc., and overall positive for the markets as well. We've got another question on the auto space as well. For the auto sector, there was some cess, levied on some of the vehicles, especially the larger vehicles, the diesel cars, etc., which would help towards the infrastructure spending. Our view is that auto companies would be easily able to pass on these higher taxes to the final consumer. So the impact on them in terms of profitability or demand is expected to be minimal. The other thing that was mentioned in this budget was that the government is looking to totally reform and sort of liberalize the permit system that we have for vehicle movement for passengers. So that should really revive demand for the bus segment. Should benefit companies like Tata Motors, Ashok Leyland, Eicher, which are into bus manufacturing as well. Yes, that is as far as the auto sector is concerned. Another question that we have is on the aviation sector. It was a mixed budget for aviation companies. Aviation companies have to incur a lot of cost on their repair and maintenance, and on that front, the government provided certain tax benefits to MRO companies which actually do the repair and maintenance for aviation companies. At the same time, they increased the taxes on the aviation turbine fuel, which is a very big item for of expense for aviation companies. I think overall that sort of made it sort of a negative net impact for aviation stocks. So yeah, I mean, primarily, I think these are the questions that we've had. Once again, I would summarize by saying that overall, this has been budget which is very pragmatic and has delivered on the key requirement of macroeconomic stability as well as rural consumption spending as well as infrastructure development. I think that's the reason why the markets are also cheering it. Foreign investors are cheering it. And from here on now, again, the focus of the markets will move on to earnings growth and sort of bottom-up stocks, which can really deliver growth and good value to investors. And those are the kind of bottom-up strategies that we would continue to focus on. Our research at Angel Broking. Thank you for watching, and please do send in any further queries, and we would be more than happy to answer.